Let's get back on track. So Alex Kanaja, I think that's right.
You nailed it, James.
No, well, that's not bad. I usually get these things wrong. I'm terrible with names, but there we go. Thank you very much for doing this. Gore Street Energy Storage, I think it's an interesting fund because it's battery storage, but not just UK. And there's lots of different moving parts to it, which I think it's going to be interesting to find out about. So if you just sort of run through the premise of the fund, please, first, and then we'll get into some questions on after that.
Yeah, for sure. Thanks, James, for having me. So what's the overall investment thesis here is driven by our energy transition. It's clear we're adding more and more renewables to every country's grid. Renewables, by their nature, excellent electricity source and one that we need desperately to replace hydrocarbons, but intermittent, will produce electricity when the sun shines and the wind blows. That's very trackable, month to month and over a year. Second to second, minute to minute, less easy to track. So all our grids are undergoing this quite incredible transition, and to enable renewables to continue to grow as a percentage of the grid and to continue to decarbonize the grid, you need to add in assets such as energy storage to help stabilize the grid. And that was the thesis that Gore Street started looking at way back in 2016. We started adding assets to a portfolio in 2017 and IPO'd now 5 years, James. Seems like it doesn't seem that long ago, but
that's incredible.
Isn't it? Right? I remember having kind of chats with you back then. So we IPO'd May 2018 on that basis, and been I think successful since. It's been I would say a journey. As you might recall, James, we IPO'd at 30 million pound market cap. We're now around the 500 million. We IPO'd with 10 megawatts in our portfolio, and we're now at nearly 1.2 gigawatts. So this is our portfolio, 1.17 gigawatts. It's interesting to see if you look, and I mentioned here, Bulby, this number one asset here on our slide, 6 megawatts. 6 megawatt hours, it means that it can produce power for 1 hour. So that, when we had that commissioned back in 2017, it was one of the largest, I think it was the largest privately owned lithium ion asset in Great Britain, and I think one of the largest assets of its kind doing grid balancing in the world. If you look at our latest transaction, Big Rock in California, 200 megawatts, 400 megawatt hours. So there's just this incredible growth in the size of the assets alongside a maturity of the sector. So we've obviously been investing here for a long time. We created this asset class for the public market with our IPO. But what we see is more and more manufacturers of quality, more and more revenue streams available to us, and an absolute realization that energy storage is this kind of critical asset that allows our transition to help fight climate change. I would add in that since early last year with the tragic events in the Ukraine, energy security also features into a kind of underpinning to our investment thesis. So this is our portfolio. We very integrated into our investment thesis is that we have the same worldwide supply chain for energy storage. Our assets are doing more or less the same type of activities in terms of revenue in the different markets that we are in, and therefore we wanted to build a diversified portfolio, not just be in one locality. So we are quite uniquely, I don't believe there's any other even utility, definitely not financial sponsor, that's operating in 5 different energy systems. So Great Britain, which is one energy system, Ireland, north and south is one grid, Germany, Texas, and California. And that diversification is very, very important to us, and I think will really be to the benefit of our shareholders going forward. Next slide, please, James. So I touched on it, but how are we making money? I think energy storage is this really interesting asset class It's firmly within the world of renewables. It's critical to our energy transition. But unlike, for instance, solar and wind, you own solar and wind. You produce electrons and you sell electrons, and you hope that you're selling them in a regime which either has a set of contracts from the government, which you hope the government continues to respect, or and you hope that the market price for the energy is as you forecast. In energy storage, our assets can do multiple things, and indeed we are doing multiple things. We have kind of three areas where energy storage can generate revenue: grid balancing, keeping the grid balanced in voltage with the growth of renewables and the decommissioning of oil, gas, and nuclear. Multiple different types of contracts here in GB. There's literally 5 or 6 different ways of making money in grid balancing, and my colleagues in Gore Street on a day-to-day basis are looking at which contracts our assets are best situated in. Ireland, grid balancing is under their DS3 contract, and there's 2 types there. And then similar types of market structures in Germany, in ERCOT, which is the Texas market, and then California. Peak shifting is where we're making our assets available for times of high demand, high consumer demand. This is a governmental contract. We were recently in the capacity market auctions about a month ago, and we did very well, locking up 15-year contracts, index linked. In Ireland, also capacity market, same in California. And then finally, trading, which is in essence buying electricity at the trough and selling at the peak. This is not a market that is that important yet. Overall, anywhere between 3 to 7% of revenue. We do it when it is available, and that's usually at times of very high volatility on the grid. But really, in energy storage today, it's around grid balancing. That's the high revenue contracts. Next slide, please. And the slide really demonstrates what I was mentioning earlier around diversification. So we obviously started investing in GB in Britain. It has been up to, I would say, about 2019, the most important energy storage market globally. A very strong growth within it. The national grid, which runs the grid, England, Scotland, and Wales, was very advanced in terms of its thinking, in terms of the contract types it was putting out, encouraging asset owners such as ourselves to invest into energy storage on the grid. But obviously other countries continue apace. We moved into the Irish market in 2019, fundamentally a different organized energy system, but with the same characteristics and the same revenue opportunity. We moved into the German market early last year. We bought an operational asset from Enel. We also moved into the Texas market early last year, and then we consolidated that with more acquisitions in Texas, and then recently an acquisition in California. And so what's very interesting is, though those energy systems, those grids, same characteristics, same type of operation, same type of systems, but are uncorrelated. So we're not tied to one country's performance, and that, again, we believe will give a much smoother revenue profile across our portfolio. Large 1.17 gigawatts energy storage. These systems anywhere between 6 to 18 months in terms of build out. I think we'll probably talk about it later, James, but one of the big constraints in the markets is the grid connections, getting the grid connections. So it's all about, for us, we purchase assets from developers with grid connections, dates confirmed, obviously land secured and permitted, and then we work back from that grid connection date in terms of the construction. We have, I think, quite uniquely invested very heavily in human capital. So we have a procurement group, a construction group, an asset management group. So we control these activities very tightly. Right now, 292 megawatts in operation, significant assets coming on stream here in GB through the rest of this year, the rest of the next 9 months. And then as we look forward into next year, in the first half, we see assets in Texas, as well as an extension of existing assets in the Republic of Ireland coming on stream, a little bit further out towards the second half of next year, we see a further asset in the Republic, and then Big Rock, I Love Americans, like the way they named it, coming on stream in California. Then further out again, 2025, 2026, we have some considerable assets. Middleton, 2026 grid connection, 200 megawatt asset to the north of England, be really, really significant part of the energy infrastructure of GB. Next slide, please. I put this slide in here, and it's, you know, to be a good investor in renewables, this is not just about energy storage. And I've been investing in renewables nearly exclusively since late 2006. You need to obviously understand finance. You need to understand technology and how it operates, how these assets operate, but you also need to understand policy. Some really big policy moves around the world of climate change and renewables recently. The biggest is the Inflation Reduction Act, absolutely game-changing, probably the most important piece of climate change legislation the world's ever seen. And, you know, to distill it down, we look at our US portfolio. Those assets, when they become operational, will be able to receive a payment of at least, and it could be even higher, but at least 30% of CapEx. In a worldwide supply chain where more or less pricing is kind of similar globally, there's some local differences in kind of construction in human costs, but more or less the same price. This is obviously a massive driver of interest then in investing in North America. America is now the largest storage market in the world. It was undergoing, in any case, a really considerable boom in solar and wind as those prices continue to fall, and it's by far the cheapest electricity generation source now. The Inflation Reduction Act will further accelerate that. We were fortunate in terms of our activities in the US. We've been working in the US market for many years now, and have our investments of last year, not the operational ones, but the assets going into construction, we believe will all benefit from what is a very considerable incentive for us to have storage on the grid. But it's also a virtuous circle. So solar and wind benefit from this act, and therefore more solar and wind will get built. You build more solar and wind, you need more storage, which also benefits from the act. So overall, a very strong piece of policy, which is encouraging a large amount of investment into the US. Next slide. The EU has responded. The EU and UK has responded both by complaining, so unhappy with the US and what they think is an act designed to lure investment into the US. Which absolutely it is. EU has put out some recommendations recently. We were very happy to see that storage was a critical part of that. Mainland Europe has been slower in developing storage than, for instance, GB or Ireland, and that's really to do with the fact that you know, the main countries like France and Germany, they balance each other's grid, so they've got a very large grid, which allows the imbalances that storage deals with, for instance, in GB or Ireland, to be less critical. But that is changing with the massive build out of renewables, plus, of course, the concern about energy storage, given the war in Ukraine. So the EU put out some very good thoughts here. We are waiting to see how those thoughts come into actual legislation and what the process is around that. You know, we hope the EU moves fast on this, but for sure, from a storage perspective, we were very happy to see a lot of things here in the 14th of March announcement. Next slide. As we look forward, we do see, we obviously have large pipeline in mainland Europe, GB and Ireland, but worthwhile highlighting the US. It's interesting as well. The US obviously is a very large country, but their grids are quite isolated. So Texas is its own grid. It's about the same size as GB's grid. California about 50% bigger, not quite as isolated as Texas, but still operates as its own. So in essence, these are islands of themselves. So that means that the need for storage is kind of dramatically increased. We have a very large pipeline in the States. We have a present portfolio of just under 350 megawatts, but a pipeline of around 900 megawatts. So very interesting investment targets for us as we look forward over the next 24 months. So how would I conclude here in terms of short presentation on our activities? We've been at this a while. It is great to see the interest in energy storage being a lot more than when we were banging the drum of it around back in 2016, 2017, and even 2018. It is absolutely accepted as this critical asset class, which will have a significant amount of investment going into it. So the market outlook, as we sit here today, has actually exceeded our expectations. We think if we go back in time to 2016. We are an active manager. We think this is really important in what is absolutely a complex asset class. So from acquisition, operation, optimization, all of those tasks are held internally, and there's a large team of my colleagues in Gore Street focused on it. Lots of assets in construction, nearly 900 megawatts in construction or pre-construction stage. We have a good amount of megawatts in kind of near-term end of construction period coming on stream over the next 7 to 9 months. And all of these characteristics have led to a strong financial performance. So 13%, I believe, for the overall. We've been averaging every 12 months around a 13% NAV total return. So I think in an asset class where we underwrite our assets to a 10 to 12% unlevered, we're managing to kind of overachieve against that target. So very proud of the performance of the company.
Great, thank you. That's not a bad introduction. So a few questions coming in. I think let's sort of group the technology ones together first. So obviously this is all lithium-ion battery storage.
Yep.
Are there any other technologies that you'd look at or you think are credible already?
Yeah, I mean, so we have the tagline technology agnostic. What does it mean? We're not buyers of technology. We're buyers of a solution, which the solution provide the services we believe the market needs. So we want to make a commercial decision on the market needs. That said, of course, there's half of my colleagues are electrical engineers and procurement specialists and construction guys. And many of them are electrical engineers. So we're deep in the technology to understand how it informs the solution. We have in the past looked at things like flow batteries. So lithium ion is a really excellent solution for very fast response. And grid balancing in the main needs very fast response. It's not necessarily the best solution for delivering power for a very long time. After about 4 hours, it gets pretty expensive. So things like flow batteries can deliver power for a much longer time, more cost effectively. As yet, we haven't seen those solutions match up with what the market characteristics need, and we have seen the lithium-ion solutions. We'd also say that we're buying assets, and to be honest, a complex negotiation with the manufacturers and the EPCs that need to last 20 years, that need to do 5 to 10 different types of activities. And so we also want a manufacturer of quality, creditworthiness, who is engaged in kind of large scale manufacturing. So we want a credible supply chain, and lithium ion can deliver that. Over the last 2 years, we've seen some very significant price increases in our supply chain. We believe they are plateauing and will start to go down. I think an interesting correlation here is if you look at the solar PV kind of market from about 2007 out, there was a spike in solar PV manufacturing costs there in 2011, 12, I believe, again driven by underlying commodities. And then as the large scale manufacturers, but mainly the Asian ones, just ramped up production, they drove the price down again. And I think we'll see that over the coming years in lithium ion. So kind of a long-winded answer there, James. We're happy to look at absolutely other technologies and informed solutions we believe the market needs. There needs to be a credible international manufacturer behind it. But as yet, we still think lithium ion is going to dominate our portfolio.
Okay. Are you actually concerned about supply chain problems? Particularly, this is questions about sort of the supply of lithium.
Yeah.
Because obviously there are all sorts of other applications beyond what you're doing for batteries.
Yeah, I mean, I think last year, last year and ongoing. So, for instance, I have regular meetings with the CEOs of the divisions who are part of our supply chain, right, in terms of building and producing these assets, matching up our pipeline and portfolio with their own individual supply chain. As one of the major players in energy storage, we have good purchasing power, but we also have good certainty of transaction for our supply chain. So they want to partner with us. If I look at our present portfolio, we have assets from Tesla, BYD, NEC, LG Chem, Samsung, Nidec, Fluence, right? So we have a wide portfolio of suppliers, and we manage them tightly. So we had no problem ever getting supply, and no problem getting supply at the right price. We are, though, energy storage as an industry is 5% of the lithium ion industry. 95% goes to EV.
Yeah.
Right. So, within that's the driver. So we do need to acknowledge that. But I think there is a constant stream of innovation around looking at the commodities within the solution and seeing how to remove them. So recently, last year, we made a decision that we would focus on a type of solution which didn't have nickel in it, because the nickel price was very high, and we wanted to remove that commodity risk from the discussion with our supply chain, and that was a very successful transition for us. So focusing on batteries without nickel. So we're involved in that level of detail. Overall, macro, there is more and more mines being opened up, and we don't believe there's a concern around that commodity disappearing, for instance, right? So we see good availability.
Okay, thank you. You've got this sort of pipeline of things that are coming on stream.
Yeah.
Do those always result in an NAV uplift?
Do they always? So basically, we definitely discount higher assets in construction than assets in operation, for sure, because we believe there's more risk in construction than operation. And so one of the interesting things about the portfolio is, given the size of assets has grown so much, we always have on a megawatt basis more in construction than operation, because we're acquiring bigger and bigger assets. We're acquiring bigger and bigger assets because we can get more money deployed in one asset, so we have higher efficiency of capital, but the capital gets deployed at a better rate because we get a better price from the manufacturers. Plus, the asset is more attractive to our customers, the grid operators, so they want to contract with bigger assets. So there's this virtuous circle. So we have a lot of assets, megawatt basis in construction. We have more sites in operation than in construction, but the asset size is getting bigger. And yes, we discount assets in construction at a higher rate than in operation. Okay,
I think that makes sense. Is there sort of like a target for the percentage of the portfolio that you'd like to be in construction or in development?
No, we don't have that. Well, what we do have a target for is what the spread of the portfolio should be. So in geographic terms, so we have a 40%. So 60% is GB and Ireland, 40% rest of the world, and so that allows us then to have a very good spread throughout the key markets we're operating in, and those key markets for us are Western Europe, North America, and GB and Ireland. In terms of assets in construction versus assets in operation, no. Obviously we're focused on having a large operational portfolio, well diversified, which produces good cash streams. I think we are reluctant probably to look at very long dated assets. So in GB, coming back to kind of the pipeline, coming back to kind of grid constraints, people are doing deals where assets won't have a grid connection until somewhere in the 2030s. We're probably, not particularly interested in adding those type of assets into the portfolio, given they're so long dated. But no set thing around construction versus operation.
Is there anything that can be done to speed up those grid connections? Is it just a matter of chucking more money at it, or is it just an insurmountable problem?
Well, if we go back to talking about policy, all right, what was absolutely missing yesterday in the UK government's kind of highlights on policy was talking about the grid. In the end, the grid is owned by private sector companies, right? So the national grid across GB, and then underneath it, the DNOs, the district operators. But that's a highly regulated business where Ofgem has an enormous amount of power around government policy, and there was no focus on how government would like to instruct, as a matter of regulation, the grid operators to incentivize storage over something else. All right. So I have a lot of sympathy for the grid operators. They're faced with a huge amount of demands, not just from storage, but from wind and solar, but also, data centers or housing estates or hospitals, right? So, it's the critical connection for our society. So they obviously are going to be under stress, and it's obviously going to be a scarce good. But if the government is serious about its targets, it needs to do something around the grid. And there was silence yesterday from the government.
Okay. You talk here, you've got 144 million to spend. What's the sort of capital requirement to build out the stuff that you identified as potential projects?
Well, maybe you go back to the pipeline to say the project slide, the portfolio slide.
Yep.
Yeah. So basically, obviously cash is fungible, right? So Middleton, for instance, that won't start construction till late 2024, maybe 2025 even, right? In terms of, so we have 144 million in cash. We are very comfortable. We have a de minimis debt position. We're starting to add in, and we've announced that we have up to a kind of 30% of GAV availability in terms of bringing on debt. We'll be quite conservative around that, right? We're in a high interest rate environment, and so we're very happy we have de minimis debt right now, to be honest. So we're fully funded with our existing equity and debt capacity out for the 1.17 gigawatts.
Okay. Is there any debt in the underlying vehicles that hold the projects?
No. So we're de minimis debt across the entire group.
Okay.
So which I think is we will for sure, an appropriate capital structure includes some level of debt. We have a 30% cap of GAV. I would be very surprised if we approach anywhere near that, to be honest. But for sure, especially given, we have in the US, we'll be looking at US borrowings, not just GBP borrowings. Big Rock also, for instance, the Californian market has a 15-year contract available, up to about 40% of the revenue. So that kind of lends itself to project finance. All right, that's an attractive project finance opportunity for the banks. So we're looking at it at both levels. But as we sit here today, James, no, when I say de minimis, it's across the entire group.
Yeah. Okay. Fair enough. Would you consider selling anything that's sort of mature and operational?
Yeah, I heard Andrew's comment earlier about managers don't like to sell their assets. We're in the business of making money for our investors. So we have built, I think, a really excellent portfolio here, well diversified across the key markets that one should be in, and we've a very long track record of being able to deliver the right set of returns. But of course, we'll always look at what is the correct balance that we should have in the portfolio against other market entrants or against characteristics that we see. So, there's no kind of religious fervor on our side in terms of we must hold at all times. We will consistently, as good managers, look at how the portfolio is balanced.
Okay, thank you. How much kind of maintenance does the portfolio need? And at what point do you replace the batteries?
So I would say it's two things in that. One, if I look at my colleagues, especially we have a full asset management group, right, which is looking at all times at availability of our assets, right? So, I think we were about 97% over the last period. So very strong availability. That requires constant attention, and we have Gore Street people who are very focused on that. So that's one thing. That's day to day, right? In terms of making sure our assets have the right availability against, generating, sweating the assets appropriately and making money at the right time. In terms of when you replace the batteries, it depends what you do, right? Grid balancing in the main is a kind of low cycle activity. So the batteries, the cells themselves will wear out faster if you do more cycles. So we see we see lower degradation of our systems in general than we expected, so that's good. But we are still in our original underwriting of every acquisition, kind of assuming around year 7 that we would replace the cells. If you did trading, which is still as yet not a big revenue source for any battery, any energy storage owner, you would probably have to replace them a little bit faster, but you'd only do that if you were making more money. So we assume in our original underwriting that cells get replaced at year 7. Things like transformers and inverters last longer, so kind of years 12 to years 15. So that's already in the financial model where we're underwriting to 10%. But yeah, there's a day-to-day thing, which Gore Street is very much on top of. And 2, there is the appropriate, accounting for and reserving for replacement of critical parts as is when.
Okay, thank you. What's the dividend policy? How does that work? And what's the cover?
Cover is about 0.7 right now on 292 megawatts in operation. And then, as you can see, a large amount of megawatts coming on in the near term. In terms of policy, we have a progressive policy. The policy dividend increases with NAV growth.
Okay, thank you. Now I've got a couple of detailed questions about the actually pricing stuff. Can you talk a bit more about some of these things? Because I know that you've already said that trading hasn't really taken off in the way that some people thought it would do. I know that some people were raising money on the back of we're going to make all the money out of trading.
Yeah, and we haven't done any.
But what's the pricing doing with things like frequency response and dynamic containment?
Yeah. So last year in GB, so let me take a step back. We underwrite our assets to declining revenue. So we believe that over middle to long term, our assets will make less and less money. Why do we believe that? Because we think that 1, CapEx will decrease for new market entrants, and there will be more and more assets built competing with our assets in the same type of revenue activities. So we assume in our underwriting that we'll be making less and less money from our assets. We were wrong on that over the last 2 years on the upside, so we're making more returns in GB. This is kind of GB story here, because to be honest, our competitors found it hard to get grid connections, or they find it hard to manage the supply chain, and as the incumbent, we really benefited. What we've seen, and these are public figures from the national grid, over the last few months, we've seen a kind of strong decline in GB pricing. So GB pricing has declined in grid balancing. There is some seasonality to that, so we see we expect there might be some uplift. At the same time, though, we also see kind of strong grid balancing revenues coming out of our Irish portfolio. So really kind of going to the diversification point, we are very happy that we're not correlated to one individual market, because those markets have some volatility in them for sure.
Okay, that makes sense, I think. Okay, we are now 12 o'clock. Do you want to say something about your share price discount?
Yeah. So yeah, I also know that, and people shouldn't shy away. So our share price has had some volatility on the downside over the last few months. I am less sure that it's anything to do with SVB, and I don't want to get started on a rant about the North American venture capital community and how they messed that up. But I think if we look at an environment of rising rate increases, coupled with obviously some really significant instability from when Truss was Prime Minister, you have a kind of rebalancing basically. So our share price, I don't know where we are today. I think we're about 101, 102, something like that. Our last published NAV was 113.5. We paid 2p since then. So, 9 to 10% discount, kind of something like that. Over the last 3 years, we've probably been at a 10% premium consistently. So the last four months, we've been operating at a discount. From our perspective, we're very proud of this portfolio. We've got really considerable assets coming on stream. We are, on National Grid's figures, the best performing revenue assets in GB, not just against the other listed competitors, but I think third in all asset owners in GB, with a well-diversified portfolio. So we continue to focus on that, and we believe that will be accretive to performance and therefore share price.
Great. Well, I hope it all comes good soon, and then we can get back to raising money to get this renewables and everything else built out, which I think needs to happen. But there we go. Thanks very much for doing this. I know we probably should have done it before. We'll get you back on again in a year or so and see how things have gone since then. But thank you for this morning.
No, thank you, James.
So we get a break next week because it's Easter. And then when we come back on the 14th of April, Richard will be talking to Regional REIT, which I think is interesting business at the moment. I think the managers just got taken over. There's all sorts of stuff going on with regional offices portfolios. There's some results this week that are probably worth reading. So it's going to be interesting to catch up with them. And then, as usual, we're populating the spread of things out into May now. And I think we've got a couple under discussion for the 5th of May. So thank you very much for today, and I'll see you in a couple of weeks. Bye-bye.